And Savita, we have had the low VIX in what? If we were in for 12 or 13, we're well below the 5-year average of 20. In your mind, what's going to be the new level of risk and volatility that we need to wind up pricing in here? We're not going to get to 20 again, right? This is a new environment. We need to re-rate our expectations.
Well, I guess I would say a couple things. So, you know, an 80 basis point move down in the S&P isn't unheard of. I mean, yeah, it's the first time this year it's happened, but it's not that abnormal. And, you know, 5% pullbacks happen on average 3 times a year. So I don't know if all of this is like anything to really read into and think this is the beginnings of a major landslide in equities. But I will say that, yes, it has felt a little bit unnerving given all of the political uncertainty and, you know, what's going on in Washington, whether or not we're getting tax cuts, fiscal stimulus, repeal and replace Obamacare. Everything seems to be kind of gumming up, and the VIX was staying at these, you know, super low levels relative to the political uncertainty index. So I think, you know, maybe we normalize from here, but, you know, I don't think this marks recession. And I think, you know, most bear markets have been accompanied by an economic recession. And I find it kind of hard to paint that picture at this point, given how healthy consumer balance sheets are, given that we're actually seeing a pickup in wage growth, but inflation isn't overheating. The Fed is tightening, but from 0 to something. So, you know, until we really see signs that consumer confidence is shot and, you know, banks have reversed lending and, you know, we're really seeing a kind of recessionary signals, I wouldn't see this as a moment to really start panicking, if that makes sense.
Michael?
Well, you know, the only thing with that issue is you talk about back in 2000 when you had a very overvalued stock market. We're not as overvalued today, but that bear market did not start with a recession. That was buyer exhaustion occurred. So that would be my concern here. We're, you know, 21.5 times trailing earnings, definitely at the high end of multiples.
Savita?
Yeah, I mean, I would just say that that in, you know, 2000, there was also this kind of convergence of assets into tech companies based on year 2000, and we did see a recession in 2001. So the market generally leads, down markets generally lead recessions. But, you know, I would also say that valuation is not a catalyst. Valuation is a really, really bad short-term predictor of when you want to sell or buy stocks. Think about beginning of '99. The market was crazy expensive, but you still wanted to be in it. So to me, the harbinger of when you want to get out of this equity market is 2 things. If we actually start to see signs of really weakening growth, and if we see capitulation-like inflows into equities. And that's the one thing we haven't seen this bull market is everybody going all in on equities. There is still this wall of money sitting in bonds that could flow into equities or cash if interest rates actually start to move meaningfully higher. So that to me is the kicker, is we haven't seen euphoria during this bull market.